I'm Rick Kahler. Thanks for joining me. Well, it's now the time to prepare for the possibility of a huge market downturn later this year. Well, it could be. A number of market prognosticators that I've been reading think that there's a good probability we'll have a W-shaped economic recovery. Now, this theory suggests that the first dip in the W was the global stock market crashed in the fall of 2008. And the upward rise in the middle of the letter is the current market rise that we are experiencing. The next phase would be another crash equal to or deeper than what we saw in the fall of 2008. And that this will happen before the final uptick, which would be a sustainable recovery. Well, I spoke about this possibility in a town hall that I did for readers of my column and listeners of my video column back in April. If the 1929-1932 bear market is any indicator, and it's the most comparable to our current crisis, we'd now be in the middle of the bear market. Bob Veres of Inside Information reported on a speech given last month by Roger Gibson, who's author of Asset Allocation. While he said it's not improbable that the next 10 years will give us annualized, or it's not improbable that we would receive double-digit returns for the next 10 years, that we may not have reached the bottom of the current bear market. Gibson's concern, which also parallels the thinking of investment advisor Lou Stanislaevich, is that the deepest recessions have seen PE, which are price-earnings ratios, hit 7 to 9. So far, our lowest PE ratio has been around 11 and currently stands around 15, which actually is the long-term average. So to reach a PE ratio of even 9, the market needs to fall 43% from where it is today, which would put the Dow right around 4,900. Now, before you jump out of your first story window, let's put this into perspective. First, almost no one saw the first crash coming. A bunch of people are seeing the second crash coming, which could be the best insurance that it won't happen. Of course, I do remember writing an article in 2004 about all the stories proclaiming that we were in a real estate bubble which was going to prove to be as nasty as the dot-com bubble. I kind of poo-pooed that by saying, well, no one saw the dot-com bubble coming, so all the predictions of a similar bubble in real estate were probably our best insurance. There would be none. Okay, maybe you should go ahead and jump. But before you do, there may be a better course of action to prepare for the possibility of another nasty down leg of this bear market. If you're retired and you followed my advice and stayed in the market, this could be a good time to raise some cash. You may want to consider selling off enough assets to fund 2 to 3 years of withdrawals. This should get most portfolios through the worst of a downturn without having to liquidate at a market bottom to raise cash. This is also a time to make sure your portfolio is diversified in at least 5 asset classes. If your portfolio is mostly in U.S. stocks and bonds, you may want to consider taking this time to move at least half of it into additional asset classes like commodities, real estate investment trust, real estate investment trusts, absolute return strategies, and treasury inflation protected securities, along with international stocks and bonds. By my estimate, investors with a broad array of these asset classes lost up to 50% less in the recent downturn than those who held mostly U.S. stocks and bonds. If you raise a little cash and diversify, the worst outcome is that you give up a point or two of return over the next 2 years. And if the worst happens, you may have bought yourself some peace of mind and the staying power to be in the game when the actual recovery begins. Thanks for joining me.